Good morning. It is Sunday, April 12, 2026. This is your deep dive daily briefing. I am your anchor, delivering a comprehensive analysis of the pivotal events that have defined the last 24 hours. We begin our broadcast on the world stage, where the strategic landscape of the Middle East has reached a moment of profound fragility. Despite the two-week ceasefire brokered by Pakistan between the United States and Iran, the situation on the ground in Lebanon has deteriorated into what international monitors describe as a humanitarian catastrophe. Overnight, reports from the Levant confirm that the death toll from recent localized strikes has surpassed 254 individuals, while the number of displaced persons across the region has climbed to over 1.3 million. This localized escalation is causing significant friction within the diplomatic framework, as Tehran and Islamabad assert that the truce should encompass all regional theaters, while Washington and Jerusalem maintain that operations in Lebanon remain a separate security concern. The United Nations has issued an urgent plea for all parties to respect the sanctity of civilian infrastructure, warning that any further expansion of hostilities could permanently derail the upcoming peace negotiations scheduled to begin within the next 10 days.
Transitioning from the front lines of diplomacy to the broader global economy, the narrative is being driven by the visceral reaction of energy markets to the renewed restrictions in the Persian Gulf. Following the Iranian Revolutionary Guard's implementation of a strict 15-vessel-per-day quota for the Strait of Hormuz, crude oil prices have surged, with Brent crude trading near $105 per barrel. This volatility is occurring as the International Monetary Fund releases its latest structural analysis, which maintains a 3.3% global growth projection for 2026 but warns of deepening regional imbalances. Economists are particularly concerned about the impact of high energy costs on industrial production in East Asia and Europe, where manufacturing activity is already facing headwinds from new trade surcharges. The IMF suggests that the global economy is currently in a state of constrained stability, where the path to a soft landing is becoming increasingly narrow due to these persistent geopolitical shocks.
In the realm of finance, all eyes are on the credit markets as they process the implications of a wartime economy and stubbornly high inflation data. The 10-year United States Treasury yield remains elevated near 4.39%, reflecting deep investor anxiety regarding the long-term fiscal implications of sustained regional instability and the mounting $315 trillion global debt burden. This restrictive financial environment is placing significant pressure on non-bank lending sectors, particularly private credit funds that have seen a surge in redemption requests from institutional investors seeking to rebalance their portfolios toward defensive assets. Furthermore, the financial sector is bracing for the leadership transition at the Federal Reserve this May, with market participants seeking clarity on whether the new administration will prioritize price stability over supporting a cooling labor market, especially as the unemployment rate has recently dipped to 4.3%.
Turning our attention to the technology sector, the focus remains on the massive infrastructure build-out required to sustain the arrival of the agentic AI era. Hyperscale cloud providers have confirmed a 71% increase in capital expenditure for 2026. Totaling $650 billion, as they race to secure the latest hardware architectures like NVIDIA's Blackwell and the upcoming Vera Rubin platforms. However, this expansion is colliding with a physical power ceiling, with global AI data center demand projected to reach 96 gigawatts by year-end. This insatiable energy appetite is forcing tech giants to explore direct investments in modular nuclear reactors and off-grid power solutions to ensure operational continuity. Simultaneously, supply chain constraints at Taiwan Semiconductor Manufacturing Company continue to hinder the fulfillment of surging demand. As the high cost of energy and shortages of specialized chemicals like helium highlight the persistent vulnerability of the global semiconductor hardware ecosystem. Finally, we look at the logistics and supply chain networks that serve as the vital arteries of global commerce, currently undergoing a period of intense structural rewiring. The de facto blockade in the Strait of Hormuz has forced every major ocean carrier to maintain the Cape of Good Hope as their primary route, a detour that adds up to 14 days to voyage times and has triggered a structural shortage of vessel capacity. Logistics analysts warn that the ripple effects on port capacity in hubs like Jebel Ali and Salalah will be felt for months, regardless of whether the truce holds. In response to these persistent maritime choke points, 72% of trade professionals have now prioritized the adoption of AI-driven adaptive networks. This shift away from just-in-time models toward a just-in-case strategy represents a permanent tax on global trade, as shippers increasingly rely on regional inventory buffers and multimodal transport corridors to insulate their supply chains from unpredictable geopolitical disruptions.